Welcome back, everyone, and thank you for watching this weekly outlook here at XM.com. I'm Christina Bartanidou, and joining me today is our lead investment analyst, Rafi Boyajan. So, Rafi, we had the ECB, Bank of Canada, and Bank of Japan meetings all this week, and the impression we get here is that although inflation and supply constraints are a common phenomenon in every country, central banks are acting in different ways. But what investors care most about these days is how the Fed is planning to move forwards with its interest rates. So how do you think the rate hike talks will develop this week when the Fed announces its policy this Wednesday? And what is the outlook for the US dollar given that non-farm payrolls are on the agenda later in the week on Friday?
Well, Christina, you're absolutely right that the Fed will announce that it's going to begin tapering its asset purchases. They're probably going to say that's going to start in mid-November. However, the move has been so well telegraphed that it's unlikely to cause much of a market reaction. Instead, traders will be paying more attention to what Jerome Powell's going to say in his press briefing. He will probably be quizzed about inflation and how soon the rate hike cycle will begin. But Powell will probably not want to talk about rate hikes, so he's going to do his best to bypass the topic. Nevertheless, we might get some hints on where the Fed stands on the rate hike timing based on what remarks Powell makes about inflation, because if he says that he's no longer so sure about inflation being transitory, that could imply that the Fed will probably raise interest rates much sooner than their previous forecast, which was the end of 2022. But if Powell manages to play it completely safe, we're probably not going to, in that case, get much of a reaction in either bond markets or in the US dollar. And the focus will then turn on Friday's NFP report. Now, as far as the US labor market is concerned, there's been quite a bit of mixed signals about it. We had that, of course, big miss back in September for the September payroll. For October forecast, the latest forecast is for a figure of 425,000, which is well above the prior month's figure. So that would be an improvement. And given the volatility that we're seeing in bond markets lately, yields will probably be very sensitive to any big surprises or misses, and that in turn would also have quite a significant impact on the US dollar as well.
Well, it seems that it will be a quite exciting session for the US dollar, but let's now move to Australia, where the RBA is also announcing its policy meeting earlier than the Fed on Tuesday. Well, what are the expectations for this central bank meeting? Could they bring some negative risks for the Aussie?
Well, the RBA is actually one of the few central banks that's managed to stay very dovish, but we may see a change in that very soon because inflation is picking up, especially underlying inflation in Australia. We had the latest quarterly data in the past few days, and also Australia is coming out of lockdown. So there's likely to be a big rebound in economic growth in the upcoming months. More importantly, over the past months, over the past week, we did see the yield on the 3-year bond yield for Australian government bonds, specifically the one that expires in April 2024. The RBA did not defend their target, which is 0.10%. So we saw that yield surging past 0.10%, and the RBA stood back and did nothing. So that suggests that we could possibly see the yield curve control policy being abandoned at the next meeting. Now that in itself would be quite hawkish. It would be a quite hawkish move, but when you consider the fact that markets are expecting the RBA to raise interest rates at least 4 times next year, the RBA is unlikely to be able to raise rates so many times. So they will probably try to push back on those specific expectations. So that would actually be quite negative for the Aussie. So even if they were to start if we were to get some kind of an announcement about winding down their emergency stimulus, pushing back on those expectations for next year, that in itself could have a bigger negative effect than the boost from their other policy actions.
Well, it seems that exiting stimulus is not an easy decision for central banks these days, and we can say that the Bank of England also belongs to this group. During its previous policy meeting, it signaled that interest rates will rise only gradually before bond purchases terminate. But then in the next weeks, its communication turned a bit unclear. Could you give us more details about how this week's meeting can develop both for monetary policy and the pound?
So there is right. We've had quite a lot of strong hints from the Bank of England since their September meeting. They appear to have been deliberately attempting to guide market expectations to bring forward the timing of when investors think rate hikes will begin. And the Bank of England has specifically been hinting that interest rates could start to rise as early as this year. So there's strong expectations going into this meeting that we could get a rate hike as early as Thursday when they meet. But of course, there's still quite a bit of uncertainty because we've heard from quite a few MPC members lately, and some of them do not appear to be fully on board about the idea of raising interest rates so soon. So we could yet see a surprise. So if that were to happen, that would of course be negative on sterling. But then again, sterling hasn't really rallied that much from these rate high expectations. It has been given a nice lift, but not as much as you would have expected because there are other concerns about the UK economy surrounding the supply constraints, labor shortages, the energy crisis, which are expected to hurt the UK economy. And so, in fact, if the Bank of England turned out to be much more dovish than expected, that might actually ease concerns about the UK growth being choked from higher interest rates and could even boost sterling. So it's quite a lot of uncertainty going into next week's policy meeting because although markets have ramped up their bets, we may yet see a surprise from the Bank of England. But either way, it's pretty certain that if not at the next meeting, then one of the upcoming meetings, UK interest rates will be rising.
Okay, Rafi, quite interesting. Definitely will keep a close eye on Bank of England this week. So this is the end of this weekly outlook. Thank you everyone for watching, and thank you, Rafi, for your insightful comments. See you next week.